Urgent. The U.S. financial system is entering a dangerous phase, not because of a single headline event, but because of a growing combination of pressures that are becoming harder to contain at the same time. At the center of this shift is the reality that the U.S. economy is operating under the most restrictive monetary conditions in more than 2 decades while carrying record levels of debt. The Federal Reserve has held its policy rate in the 5.25%, 5.50% range for an extended period, signaling that inflation risks remain unresolved even as economic momentum slows. While headline inflation has cooled from its peak, it continues to hover well above the Fed's long-term 2% target, keeping real interest rates firmly positive. This has created a fragile environment where borrowing costs are high, liquidity is tight, and financial stress builds quietly rather than explosively. At the same time, the U.S. Treasury is issuing massive amounts of new debt to finance ongoing deficits, pushing total U.S. government debt beyond $34 trillion and increasing annual interest expense at a pace that is becoming politically and economically sensitive. Yields on long-term treasuries have repeatedly tested levels above 4%, forcing markets to reprice risk across equities, real estate, and credit. What makes this phase particularly dangerous is that none of these pressures are isolated. Banks are facing higher funding costs, commercial real estate remains under strain, and credit conditions for consumers and small businesses continue to tighten. Yet outwardly, markets still appear functional, and that illusion of stability is what often precedes deeper stress. Historically, financial systems do not break. When problems are obvious, they break. When multiple constraints converge and flexibility disappears. Right now, the U.S. financial system is caught between the need to keep policy tight to control inflation and the growing cost of doing so. In a debt-heavy economy, that tension is unsustainable over long periods. The danger is not that a collapse is imminent tomorrow, but that the margin for error is shrinking rapidly. Each new data release, each Treasury auction, and each policy decision now carries more weight than before. This is the phase where confidence matters more than optimism, where liquidity matters more than growth narratives, and where small shocks can have outsized effects. The system is still functioning, but it is doing so under increasing strain. And history shows that this is exactly when risk stops being theoretical and starts becoming real. What makes this phase especially concerning is how liquidity is being drained, while risk is quietly accumulating, a combination that historically exposes weak points across the system. Since 2022, the Federal Reserve has reduced its balance sheet by more than $1 trillion through quantitative tightening, pulling reserves out of the banking system at the same time that higher rates are raising the cost of capital. This matters because modern financial markets run on liquidity, not just confidence. As reserves decline, banks become more selective, lending standards tighten, and credit availability shrinks, often unevenly. Large institutions can still access funding, but smaller banks and regional lenders face rising pressure, especially those exposed to commercial real estate and longer duration assets purchased when rates were near zero. Recent regulatory filings and earnings reports have already shown stress in office real estate, declining loan demand, and higher delinquency rates in certain consumer segments. Meanwhile, the U.S. Treasury continues to absorb liquidity by issuing hundreds of billions of dollars in new bills, notes, and bonds to fund deficits, effectively competing with the private sector for capital. This creates a subtle but powerful crowding out effect. Money that might otherwise flow into productive investment or risk assets is instead parked in government debt yielding 4%, 5%, reinforcing tight financial conditions even without further rate hikes. Markets often underestimate how dangerous this setup can be because it doesn't look dramatic at first. There are no immediate crashes, no emergency announcements, just a steady compression of flexibility. Historically, periods like this are when financial accidents occur, not because policymakers act suddenly, but because the system has less room to absorb shocks. A weaker earnings cycle, a failed Treasury auction, or renewed stress in a specific sector could quickly spill over once liquidity thins. This is why the current phase feels unstable beneath the surface. The system isn't breaking yet, but it's becoming increasingly rigid, and rigid systems don't bend well when pressure rises. There's also a deeper, less discussed reason behind my decision, and it has nothing to do with silver itself. It has to do with behavior. Financial markets are driven by human psychology long before they're driven by math. Right now, silver has become a symbol. It represents protection, rebellion against fiat currency, and a hedge against a system many people no longer trust. While those ideas are valid, symbols tend to attract emotion, and emotion tends to distort timing. When an asset becomes a statement rather than a calculation, it often trades ahead of its fundamentals. I've seen this pattern repeat across cycles. The asset is ignored for years, then suddenly it becomes obvious, and that's when late capital rushes in. That doesn't end the trend, but it often pauses it. What concerns me is not that people believe in silver, it's how confidently they believe the move must continue in a straight line. Markets never move that way. They test patience. They shake out weak hands. They create moments of doubt precisely when conviction feels strongest. I prefer to enter when uncertainty is high, not when confidence is widespread. Another element here is narrative fatigue. When the same bullish arguments are repeated daily, supply shortages, industrial demand, monetary debasement, they lose their power to move prices higher in the short term. For markets to advance, they need new information, not recycled conviction. At the same time, risks that are currently ignored, policy shifts, liquidity tightening, or sudden changes in risk appetite, don't need to be large to trigger a pullback. Silver doesn't need bad news to fall. It only needs expectations to cool. This is why I'm focused more on preserving clarity than increasing exposure. Owning silver already gives me alignment with the long-term thesis. Adding more right now would be about emotion, not strategy. And when emotion starts guiding decisions, the margin for error disappears. Stepping back allows me to stay objective, to watch how price reacts when optimism meets resistance, and to be ready if the market offers a better entry. Discipline isn't about being early or late, it's about being intentional. Another warning sign is emerging from asset pricing and risk behavior, which increasingly looks disconnected from underlying financial conditions. Equity markets, credit spreads, and volatility indicators are all sending a message of relative calm, even as borrowing costs remain elevated and growth momentum shows signs of fatigue. This disconnect is dangerous. When markets price stability while policy remains restrictive, it often means risk is being mispriced rather than eliminated. Investors have grown accustomed to the idea that the Federal Reserve will step in if conditions deteriorate, but that assumption is being tested by inflation that refuses to return cleanly to target. At the same time, corporate refinancing risk is rising. A large share of U.S. corporate debt was issued when rates were near zero, and as that debt rolls over, interest expenses increase materially. Even a few percentage points matter when leverage is high. Analysts have already noted that interest coverage ratios are weakening in certain sectors, particularly among smaller firms and highly leveraged borrowers. In housing and commercial real estate, higher rates have frozen transaction activity, masking stress rather than resolving it. Prices don't collapse immediately, they stagnate. Volumes dry up and balance sheets quietly deteriorate. This slow burn dynamic is often misunderstood as resilience, when in reality it reflects delayed adjustment. History shows that financial stress often builds during periods of apparent calm, not panic. When capital becomes more expensive and liquidity scarcer, risk doesn't disappear, it migrates. It moves into corners of the system that receive less attention until something breaks. The longer this environment persists, the more fragile the structure becomes. Markets are not reacting because they are still anchored to past playbooks. But this cycle is different in one critical way. Policy flexibility is constrained. That makes today's calm less reassuring and tomorrow's adjustment potentially more abrupt. Taking everything into account, these signals suggest that the U.S. financial system is becoming progressively weak under the pressure of various forces at play, even as it maintains an outward appearance of functioning. Excessive interest rates, dwindling liquidity, rising refinancing costs, and persistent fiscal imbalances are not problems that can be resolved unequivocally. All of these factors reinforce one another. The reason why this particular stage is increasingly hazardous is that it fosters a sense of complacency among markets. With markets consistently anticipating intervention, stability, and eventually relief, the probabilities for those outcomes are becoming progressively restricted. The Federal Reserve, is now unable to react as freely as it once did without the potential of jeopardizing inflation credibility. And simultaneously, the U.S. Treasury has to continuously borrow assets even under ideal market conditions. This circumstance narrows the available options across the entire financial system. Historically, this juncture in a cycle is where stress does not need to be particularly severe to start becoming disruptive. It only needs to appear at the wrong time. An elementary economic slowdown, an unexpected jump in inflation data, or an episode disrupting the credit markets could conceivably amplify the negative effects because existing buffer mechanisms are already thin. This doesn't imply that collapse is unavoidable, but it does emphasize that the system is less elastic and more resistant to change than it appears. The principal danger isn't posed by a single shock, but rather by the continuous buildup of constraints that make recovery slower and the adaptation process more challenging for investors and observers alike. It is essential for investors and other observers to remain aware of this fact. Taking into consideration that the current stability is achieved at a higher cost helps to explain why risk becomes increasingly uncomfortable and why vigilance is of greater significance in the current circumstances than it was during periods of more accommodating policy. The U.S. financial system has experienced hardships in the past, but there is no doubt that history has demonstrated that periods of seemingly calm combined with challenging conditions and reliance on high leverage are rarely sustainable for an extended period. This presents a moment, one where the next stage will be shaped not by confidence, but primarily by the system's capability to absorb strain and endure change.